Hello, everyone, and thank you for joining us. My name is Amanda Kramer, and I am the Alumni Engagement Program Manager at the University of Colorado Boulder's Leeds School of Business. Welcome back to another COVID-19 webinar series. These are certainly trying times, and here at CU Boulder, we have gathered our world-renowned faculty and alumni to provide frank and timely insights for life during and after the COVID-19 pandemic. Today is the first of 4 webinars in this COVID-19 related webinar series. To view upcoming webinars, please visit our website at colorado.edu/business/alumni. Click the drop-down arrow and click Attend Online Webinars. For today's webinar, we are so excited to welcome back Leeds Associate Dean and Senior Economist, Dr. Rich Wobbekind, and Executive Director of the Leeds Business Research Division, Brian Lewandowski, here presenting a COVID-19 economic discussion, what we have learned over the past 4 months. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask Rich and Brian, please send a question through the Q&A interface. We will monitor questions as they are submitted, and Rich and Brian will respond to them at the end of the presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speakers. If you experience any technical difficulties during the webinar, please notify us through the chat interface, and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants tomorrow, along with the survey link for today's presentation. Now, I am so excited to introduce today's speakers. Associate Professor Richard Wobbekind holds a PhD in economics from the University of Colorado Boulder and is, amongst many roles at the university, Associate Dean for Business and Government Relations, Senior Economist, and Faculty Director of the Business Research Division. As Faculty Director of the Business Research Division, his responsibilities include developing an annual consensus forecast of the Colorado economy and performing various economic impact assessments of the Colorado economy. Wobbekind also produces the quarterly Leeds Business Confidence Index for Colorado. Rich is joined today by Brian Lewandowski, Executive Director of the Business Research Division at Leeds. Brian specializes in economic and revenue forecasts, policy studies, and economic impact analyses. Welcome, Rich and Brian, and thank you so much for being here. I'm going to hand the webinar controls over to you now, Rich.
Well, thank you, Amanda, and thank the many of you who are joining us today, both through the Zoom series and also live streaming on Facebook. So it's great to have you here with us today. This is the third one of these that we've been doing for Leeds and the University of Colorado Alumni Association. They've been spaced out roughly 6 weeks apart. And Brian and I decided very early on, because of the unbelievable uncertainty of such an event like this, that we should be talking about this as an economic discussion, not specifically as an economic forecast like we have done in the past for many, many years. So I'm going to comment a little bit along the way on some of the things we have thought from the beginning, and I know many of you are back as repeat attendees, but there are plenty of new people as well. So you won't be lost on the presentation if you didn't see the earlier ones. We'll talk about some of the comments about things we've learned as we've gone through this. So as mentioned, I'm very pleased to be doing this with my colleague, Brian Lewandowski. He's going to be doing the second part of the presentation that'll focus more on the Colorado data. And I'm going to be working more on the front end, talking about the virus and talking about the sort of more macroeconomic impacts. One highlight, of course, is that Colorado could do better or could do worse than the nation, but we need the national economy as part of the recovery for the state economy. So we always like to put the state economy in the context of the national economic picture. So this is sort of an overview, and it's a little different than some of the things we've said in the past, but let me just sort of move through this. We've certainly seen a resurgence in domestic cases. Prior to this, the U.S. economy was on very, very strong footing. We believe the CARES Act and Federal Reserve policies, even with flaws, have done a lot to help mitigate the impact. Not completely, but at least help mitigate it. Certainly, certain industries have been more disproportionately impacted. And why that's important is that, some industries, there's been talks of all different types of recoveries, a V-shaped recovery, a U-shaped recovery, an L-shaped recovery. You hear all these different letters. But the conventional wisdom early on was it seemingly there would be a pretty good V part to this. And I'm going to address that as we go along. And now I think we have settled in, at least, that it's going to be more like the swoosh, like the Nike swoosh recovery, that some industries are coming back like a V, but a lot of industries, it's going to be a much slower road back to full employment. A couple of other quick things there, and I'll say this when we get to the slides. The last 2 months of employment numbers have been tremendous. I'm going to suggest that I don't think that's sustainable, that you're not going to continue to see sort of a V-shaped recovery in employment. And then you're going to hear from Brian talking about Colorado outperforming the nation. And it's one thing I would like to highlight, this very last bullet. Not going to address it a lot unless it comes up in the Q&A, but it's obvious at this point that there's going to be significant structural changes from what has happened, including everything up to and including the way we're delivering university types of programs, but all sorts of things, the work from home and what that will mean for office space or for commuting patterns, or for telecommunications infrastructure. Obviously, the impact on retail, the continuing movement to e-commerce, what that's going to do for retail, but also what it's going to do for, say, retail space, if you will. And then the migration, is there going to be this movement? There's suggestions there's going to be more people who can work from home, moving to more rural types of places. But there's also suggestions that inner city kinds of office space will be somewhat supplanted by more suburban types of office space that isn't quite as congested and might fit the need a little bit better. So there's all sorts of thoughts out there that are, and we can talk more about those in the Q&A if there's of specific interest. And I guess I should have said, maybe even led off with this, obviously the difference in trade patterns with China and issues related to outsourcing and offshoring, and how much of that's going to return to not just the US, but even to our neighbors to the north and south, to Mexico or to Canada, as we sort of shorten up supply chains. So as mentioned, the cases, by country, you can see the sort of dark red places, and of course the U.S. has almost 2 times the cases of the number 2 country in the world. There's differences in measuring going on. It's very tough to have comparable data, but we have seen, as mentioned, we have seen a little bit of a resurgence in cases. 40 out of 50 states are showing an uptick. One thing that is not quite as bad is we're not seeing a rapid rise while we're seeing a significant rise in the number of cases, we're not seeing a significant rise in the number of deaths. So maybe we've learned how to address this a little bit more. Some of it's related to the fact that some of the increase in cases is younger people who are people who are less prone to bad outcome, if you will, from the disease or from the virus. So we've seen in terms of per capita, something I talked about, I think on the first broadcast, maybe the second one that we did at the end of April, beginning of May, but we had seen really intense problems up in the Northeast. Some of it was attributable to transportation patterns, transportation uses. But what we have seen, and that area is still Massachusetts, New York, New Jersey, Washington, D.C., still very high in terms of per capita cases. But more recently, as you know, we've seen resurgence in Florida, Texas, Arizona, California, a little bit in the Carolinas, and that has caused the economy to reopen at sort of different rates. So you probably have heard about the bars being closed again in Texas and in Florida. And of course, this challenges the speed of the recovery. So instead of having this quote V-shaped recovery, if you have the resurgence of the virus, then you're likely to have, again, a slower recovery, at least in certain types of industries. And that's why we're sort of more prone to this position of the swoosh. So what we've seen, of course, is first quarter 5% GDP decline. The second quarter is going to be somewhere in the minus 30, 35% range, sorry, minus 30 or 35% range. And this is, it's important to note, this is an annualized rate based on a quarter. So we're not saying minus 35% for a year, we're saying minus 35% if you annualize that growth rate for the entire year. If you actually went back in time for the whole year, you'd be down in the minus 7% range or something. So this is a 1 quarter phenomena. And then we're also anticipating a bounce back, although with the resurgence, we had been saying numbers like plus 20% in the next quarter. Those might be dampened if we start to see, again, some of the closures happening or slowdown in the rate of reopenings of other types of businesses. So something to keep our attention to. What we do know is that in February, the National Bureau of Economic Research officially documented that we went into a recession. We'll talk about this a little bit more later. Highly likely to be one of the shortest recessions, but obviously the most severe. So you'll see a graphic that relates to that in just a little bit. Knocks us off our potential GDP path. Of course, this has been growing at a 2+% range in good times. It hasn't been growing at like 3.5% like it did back in the 1990s. And if you summed up all of the GDP that we lost, the difference between the red and the blue lines, you would see that from the 2008 recession, the amount we're projected to lose now, as projected by the Congressional Budget Office, even though the bounce back cover happens faster, the projected loss is 4.7 trillion of GDP, is very close to what happened in the 2008-2009 recession. We get back on track, according to the Congressional Budget Office, out in 2028 in terms of the growth rate getting back onto the potential path that was out there. As mentioned, we had big employment numbers. We saw in a 2-month time span, these are 2 months linked together, we saw minus 22 million jobs in March and in February and March, and then April and May we've seen, May and June we've seen plus 7.5 million. So March and April minus 22 million, May and June plus 7.5 million. So a really nice bounce back, but suggesting that that's going to be very hard to maintain in light of really 2 factors. One is, again, the bounce back of the virus and maybe slowing some of the openings. The second piece is businesses actually now beginning to seriously fail. So we've seen businesses announcing that they're not coming back. So these temporary layoffs are now becoming more permanent. So it's going to be hard to maintain this sort of a bounce back, if you will, of employment growth. So we've gained back about 1/3 of the jobs, but we've still got a number of jobs out there. The employment growth has been better in certain parts of the country than others. 2 states that are very, very heavily tourism dependent, you can see Nevada and Hawaii have had very, very difficult 1-year growth rates through May. Again, the state level data is only through May. The national aggregate is through June at this point in time. So that's why you see a differing number back and forth. But you can see Colorado, while not in the best category, the bright yellow is in the sort of second category, something Brian will address in greater detail in just a few minutes. So this is refers back to my earlier comment about this size of recessions. You can see we already know how deep the peak to trough went in 2020. We can already graph that because we know we've bounced back off the bottom, if you will, of the trough. But how many months to recovery, we don't know. I'm suggesting in terms of employment, it's probably going to be out in 2022. So you can, we originally were saying something like 36 months. That's still seemingly not too crazy or inaccurate in terms of the employment getting back there. We're going to have eight months or so this year, and then 12 and 12 the next couple of years. So sometime out in 2022, after we get through 2020 and 2021, we'll get back to the previous level of employment in the economy. So this is an interesting piece. After, I think on the very first piece, I was talking about the unemployment rate getting back under 10% by the end of the year. And there were people who joined the last time and said the numbers were so high when we did the last one. People were saying, "Are you still sticking by your number? 10% by the end of the year." But as you can see, we're at 11.1% in the most recent monthly data, down from 13.3 the previous month. So under 10 seems not only possible, but highly likely, I think. We'll be down in, maybe even the 9% range by that time. But I don't see us getting back to 3.5%, which is where we were nationally going into this, until 2022 or maybe even beyond, in terms of issues related to loss of productivity and other things. Again, maybe we can address a little bit more when we get to the Q&A. I highlight the right-hand side. These things we probably know, but are obviously surfacing in terms of the 11.1, even though the data on the right is not seasonally adjusted, so it's slightly different in terms of the numbers. We don't have this kind of breakdown for the right-hand side with seasonally adjusted data, so it's not seasonally adjusted. But you can see certain categories of workers, 20 to 24, for example, very high rate of unemployment, young people, the types of industries they might be in. As we always know, unemployment's highly linked to education level, and it is this time as well. Much higher unemployment rates with the lower levels of education. We also know that Black African Americans are suffering a little bit more, as are Hispanics or Latinos. And this particular one, we've seen some of the professions that women are more highly concentrated in also suffering, healthcare as an example. So these are just giving you more information in terms of the slides of sort of demographic impacts, if you will, of the unemployment situation as we see it now. Okay, picking up the pace a little bit, we have seen a pretty big drop off in labor force participation rates. They have been coming down historically all the way to the 2008 recession. We had seen a little bit of an uptick and more people entering into the workforce, but we have seen a pretty significant drop off. Hopefully we'll see some of that come back, but the year-over-year change has been particularly strong in terms of participation for Asians and for men in general. I mentioned down below the female rate in terms of year-over-year change, but you can see just in terms of overall rate of participation, we're seeing the sort of lowest rates of participation down amongst Black or African American women, and then white women down at the bottom of that graphic on the right-hand side. Moving forward, these are the initial jobless claims. You've been hearing a lot about this. It's weekly data. This is updated as of this morning. And this has been trending down. You can see it was up at 6 million and then 5 million and 4 million and 3 million. And it's down to 1,314,000 as of last week, 4th of July week. Two things I, again, pointing out, don't be dancing in the streets here. The downward trend is great, but this is still a larger number than we saw in the Great Recession in terms of the number of weekly claims. This is getting down to a number that's the highest number we ever saw during the 2008, 2009 recession. And then on the right-hand side, just in terms of continuing claims, that's down now to 18 million, but that's still a tremendous number of people who are unemployed. As you can see up at the top going into this, under 2 million continuing claims, and now we have 18 million continuing unemployment claims. Raises the whole policy issue of continuing the unemployment benefits, the federal subsidy to the unemployment benefits. Right now it's looking at, based on what we're seeing in Washington, that we're going to see a break in that, at least for a period of time, that they won't be enacted. Nothing will be enacted fast enough, it looks like at this point, that those benefits will continue after the end of July, will immediately continue after the end of July. Again, you've seen a surge in income both in April and in May related to the transfer payments, the green part, unemployment insurance, the tax cut that was sent back in April 15th, and so on. Consumer confidence fell dramatically, but not as bad as the 2008 recession, or not even as bad as the recession in the early 2000s, and has come back a little bit. It's stable. So we are seeing a lot of sort of positive signs out there on the overall economy in terms of the surveys that are out there and so on. You can see a lot of positive pieces. I just think in terms of the quote concept of a V recovery, a V-shaped recovery, going to be hard just because of, again, business failures, occupancy rates at 50% in restaurants, and so on. So this brings up national retail sales, and this is March and April combined, and you can see how hard some of the sectors were hit, other than electronic and mail order at the top, which you can imagine with all of the e-commerce and food and beverage stores. You can then see every other category in negative territory, March and April combined, and particularly down in the bottom left-hand quarter, clothing and accessories. So just yesterday, Brooks Brothers announced bankruptcy filing, continuing on a path of how many sort of retailers and national retailers are sort of falling into this category of difficulty in maintaining business or on a continuing basis. We did see April to May, the most recent month, nice jump backs in clothing and furniture and some of the areas that were hit hard with the reopening. But again, these are percentage increases from April to May, and April, of course, was dire. So you're seeing overall jump back again as we reopen, but it's not getting to the levels that it needs to be to sort of sustain all of the businesses that were out there, and maybe we're in tenuous position going into this downturn. Huge jump in e-commerce, not surprising. And the right-hand graphic, if you're not familiar with it, is the percent share of e-commerce. So you can see it's percent share of retail that's coming out of e-commerce. So we have seen this kind of big jump up, and it has, it's been significantly, percent changes have been higher, but of course, the difference between the lines has been greater in this particular recovery because of the stay-at-home and other pieces involved with that. We have seen, again, in other signs of more positive indicators, we have seen the ISM indices or indexes up both in positive territory, expansionary, above 50. In particular, the one on the right-hand side, which includes the services sector, a big jump up into the high 57.5, indicating the pent-up demand as these businesses opened opened up. There was a lot of pent-up demand, and it was a really good signs of recovery there. Industrial production, dramatic drop off, also capacity utilization. It has bumped up a little bit. We are paying a lot of attention to this. This is the more industrial side of the economy. And again, these are at very low levels. We like to have capacity utilization up in the close to 80 range, and you can see capacity utilization for the economy down in the 65% range. So we'll see as more manufacturing opens up and reboots, whether we'll see again increased demand in terms of industrial production and capacity utilization. Also being impacted, quite frankly, by the airlines industry and tourism. We have industrial production for airlines and airline producers. Those things are pretty low levels. Our own confidence index bounced back for the next quarter to slightly below break even, slightly below 50, and then the 2-quarter out number went up above. And so reasons for that response were the end of lockdowns and the reopening of the economy, but also there were concerns about current politics, certainly about bankruptcies, and the impact. In our last survey, there was also mention of the impact of protests, whether that was going to sort of slow the recovery of the overall economy. Again, this is focused on Colorado, this particular index. So moving ahead to just some numbers, lots of people asking questions about the stock market, including some of the questions that were submitted. Is this crazy? I think there's two things you could say. Financial markets tend to move ahead of the real economy. The financial economy moves ahead. A lot of the financial economy looks pretty good, but there is just so much liquidity out there. What are the options for people? Where can they put their money and get any sort of rate of return? So you can see that still from down below, the broader index, the Russell 2000, is still down, and also the Dow Jones is still down from the 100 mark from a year ago. But we are starting to see some pretty nice increases in the market since those March and April lows. And then we have also seen, again, movement into the market, but there's just tons of money sitting on the sidelines, and that could lead to even higher prices over the long haul. People just start to not know what to do with their money, if you will. And again, then the economy starts to recover, then corporate earnings start to recover, all the things you might hope for. Interest rates, again, we've got 2020 on here, and you can see we're starting to get to a more normal spread between the 3-month and the 10-year, which is a good sign, upward sloping yield curve. We see that trending up, if people are interested, trending up slightly over 2021 as you go forward, but not trending up all that much in a benign inflation environment that Brian's going to talk about a little bit later in the presentation. And then just the last couple of comments. We are seeing some trends up here in terms of delinquency rates, particularly in credit card in red. We're starting to see some movements up there. We have seen in the monthly credit card data that the monthly consumer credit data that comes out, significant drops in credit card balances. So that, of course, would impact consumption to some extent. We have seen non-revolving credit going up, which would be things like auto loans. So we have seen some movement up in the volume there, but we have seen a pretty significant drop the last couple of months in the non-revolving, in the revolving credit card type category. Household wealth also, as you know, in the first quarter took a pretty significant hit. We'll see where quarter 2 goes, but likely to be up from quarter 1 with the bounce back we saw in the stock market. This data lags a little bit. This data, wealth would also indicate an increase in consumption out there. The budget, I'm not going to sort of lose sleep over this, but we're talking about over a $3 trillion deficit this year, and next year looking at over a $2 trillion deficit. I don't know that there's much we can do about that in the short run, but it's obviously something people are going to need to think about over the long run. The Congressional Budget Office does very good work in this area if you're interested. The implications of the amount of debt the government's holding and what that might mean to longer run growth rates in the economy. Finally, the last couple of comments. This is the 1-year change through June, which industries have been hurt the most, and in an absolute amount, and not surprisingly, you see accommodations and food services, over 3.5 million people, 1-year change. Then you see government, waste and management, retail, and so on. Again, you're starting to see the effects of what I've been calling the collateral damage is now moving on to government and to weak retail. And so you're starting to see the sort of secondary effects of lower tax revenues on the economy. And this is the 1-year percentage change. So just in terms of percentage change, you can see that accommodations and food services, arts, entertainment, and recreation, you can sort of make your way up on who's losing the most. But as you move up overall, there's an overall government one up there, but you can see that local government has, up in 7-8% range at this part. And then you see state government up there as well. So you see a loss in government jobs at both the state and federal, state and local level, where at the very top you can see there's an increase in jobs in overall federal government employment. So with that, I am passing the baton to my colleague, Brian. I very much appreciate my time with you. Sorry, I've been looking a little bit to the left, but I have to see the slides that I'm talking to. And Brian, take it away.
So I'm going to spend about 15 minutes relating Rich's comments to the Colorado economy. And I like to start out by showing you Colorado's ranking among the 50 states, because it's helpful to sort of understand where we sit in the context of the rest of the nation. And one thing that Rich and I have shared for the last 8 years or so is that Colorado has been on this path where we've been outperforming the national economy and outperforming most other states. So you can certainly see that when you take a look at our ranking on a 3-year basis, or over the last 5 years, or over the last 10 years. And one other thing that we have been sort of reiterating time and time again is that Colorado's economy has been on a slowing trajectory. But I think what's interesting is we sort of reflect on where we sit right now in terms of the first quarter GDP, or taking a look at employment growth through May, or the unemployment rate through May, is we're actually not performing that poorly compared to the rest of the nation. So for many of these metrics, we still remain in the top quartile or even the top quintile, especially when it comes to real GDP growth, where we rank 7th. Per capita personal income, we still rank 11th. For the unemployment rate, though, we look a little bit more average, where we're 22nd among the 50 states. So I'm going to talk about these a little bit more in a moment. But when it comes to real GDP, just be mindful that even though we're 7th best, it doesn't mean that things are good. So year over year, our GDP rose a little bit through the first quarter. When we take a look quarter over quarter, though, from the fourth quarter of 2019 through the first quarter of 2020, which includes March, which was kind of our first pandemic month, we had a decrease in real GDP, as did every other state in the nation. And our annualized rate of drop was just over 4%. So in terms of initial jobless claims, we are seeing an improvement in initial jobless claims. So last week, this number was just reported this morning, Colorado had about 7,700 initial jobless claims, which is certainly better than at any point since the pandemic started. We can look all the way back to the week of March 21st. So that number is improving, but also note here that 7,700 just about matches the worst week that we had during the Great Recession. So I think that's a good comparative mark, that even though compared to any point during the last 14 weeks, we are on an improving trajectory. It's very, very much one of the highest numbers that we've ever seen in Colorado. And then we sort of sit back and reflect on this difference between initial claims and continued claims. So initial claims is a nice leading economic indicator. because as we start to be furloughed or as we start to lose our jobs, one of the first actions we take is we go up and sign up for unemployment insurance benefits, just to kind of keep our financial household as whole as we can. So you sort of see those transactions come in very quickly. Continued claims is really what happens after your initial claim. So you're an initial claim 1 week, and then every week thereafter you're a continued claim. And what we're seeing with the continued claims is they also spiked to record levels, but they remain at record levels. They remain extremely high. We're not seeing much improvement in this number. And while most states saw an improvement in this number 2 weeks ago, Colorado actually saw this number increase 2 weeks ago. When we take a look at claims by county, so one reason why I end up focusing on labor data is because it's a good barometer for the economy in many ways. We can sort of break it down spatially by county, we can break it down by industry, we can break it down for different population groups. So that's where I'm going to spend a lot of my time today is really describing a lot of this in terms of labor data. So when we take a look at the continued claims by county, we can really see where the unemployment impact really hit. So the darkest areas on this map are showing you where the highest levels of continued claims as a percentage of overall employment have been measured. And so these are mostly our commuter counties and our mountain resort communities. So places like Park, Clear Creek Lake, Eagle Summit, San Miguel, these are places that had about 20 to 30% of total employment, people signing up for unemployment benefits. So this is really showing you that maximum continued claims as a percentage of employment. But I think what's interesting here is when we take a look out, especially to the Eastern Plains. So the Eastern Plains on the right side of the map, these are areas that were arguably left out of the Great Recovery following the Great Recession. These are largely our agricultural communities in Colorado. These are places that have noted not only decreasing employment over time, but even in some cases decreasing population. But now what we're witnessing out there is their maximum continued claims by county as a percentage of their overall employment is lower than anywhere else in the state. We're really looking at 1 to 3% of their total employment is signing up for continued unemployment benefits. So there's kind of an interesting irony there. When we take a look, so this slide is showing you the maximum continued claims by county. When I fast forward one and take a look at current continued claims by county, so this is as of 2 weeks ago that we can see this data, the story is very much the same as when we looked at the maximum. So we've noted some marginal improvement by community, but those hot spots that I noted, the commuter counties and the mountain resort counties, those continue to be the hot spots in terms of continued claims. And the Eastern Plains that had a comparatively low rate continue to record comparatively low rates. The other thing that I want to note as far as different groups that have been impacted, Rich was reflecting on the unemployment rates by gender, race, ethnicity at a national level. When we take a look at continued claims and initial jobless claims in Colorado by gender, race, and ethnicity, it's mostly the same as what Rich shared with you, but with a couple of small differences. We too have a higher rate of women signing up for unemployment benefits than men in this cycle. We also see higher rates among the Black, African-American, Asian populations. But one interesting difference is that we see a lower rate of initial claims among the Hispanic, Latino population in Colorado. We also do see higher rates of unemployment benefits being paid out to people between 20 and 34 years old. So There's some similarities and there's some nuanced differences within that data. When we take a look at continued jobless claims by industry, this highlights what we've shared with you in prior presentations, that accommodation and food services, retail trade, arts, entertainment, and recreation, the healthcare sector, these are industries that have been the hardest hit by the pandemic. And this is really illustrated in the continued jobless claims. So the red bars are showing you the highest rate of jobless claims during the pandemic. And then the gold bar is really showing you the percentage of jobless claims to total industry employment now. So what we can see here is that there has been an improvement, right? So for accommodation and food services, we have seen that number improve over the last 6 weeks. For retail, we've seen that number improve, and we should. As these businesses reopened, they went from being shut down to being reopened. And so naturally, as those workers come back, you should see them roll off the unemployment benefits and be a regular employee again. So we have seen some improvement, but I think what we should note here is that these are still alarmingly high levels, especially for those industries. It really looks like a marginal improvement for the tourism industry and for the retail industry. But also take a look at some of the industries that have comparatively low numbers of jobless claims. So we're talking about the information industry, finance and insurance, company headquarters, which is management of companies and enterprises, wholesale trade. So comparatively, we've seen lower rates, and we're also seeing smaller percentage improvements among those industries. So initial claims and continued claims are sort of nice leading indicators. They provide us information before we get the actual jobs report from the Bureau of Labor Statistics. And so now let's sort of segue into what we know at a more granular level from the Bureau of Labor Statistics about industry employment. So what we saw over the 2 months, really ending in February through April, so these are job losses in March and April, we saw Colorado lose about 360,000 jobs in a 2-month period. Like many of these indicators, that was a record decrease. But from this slide, you can really identify the hardest hit industries, similar to what I was just sharing. So our tourism industry, so this is accommodation and food services. So think of hotels and restaurants and bars. Think about the retail sector. Think about the ski resorts in arts, entertainment, and recreation, and other sporting events and concert venues. And then healthcare and social assistance, because while healthcare has been very busy dealing with the pandemic, a lot of healthcare was actually sent home, like many of us, because they couldn't see their patients. So that's where we saw the greatest job losses over that 2-month period from March to April. As we fast forwarded into reopening, you can start to see where we started to add jobs back. So in May, we saw job growth in the state of about 68,000. That's remarkable 1-month growth. That's a record increase in jobs for a single month. And you can take a look at this and see that accommodation and food services, healthcare, our recreational venues. So all of these that recorded record losses also posted really strong gains in May. But it's a little bit deceiving, because I think that you should also just be aware that when we take a look at these industries year over year, there's just a remarkable deficit of jobs. So for accommodation and food services and arts, entertainment, and recreation, that deficit is about 37%. So it's good growth, but there's a long way to go before these industries really get back to their pre-pandemic levels or get back to par. We can also relate this to the unemployment rate. So this is another one of these lagging indicators. This is really a delayed reflection of what we see in the initial jobless claims and the continued jobless claims. We saw Colorado's unemployment rate top out at 12.2% in April. We saw this improve to 10.2% in May. And again, we're 22nd best when it comes to our rate of unemployment. And that really brings us to Colorado's employment growth. So when we take a look at May year over year, we're down about 8.6 or 8.7%. But when we take a look back at the data on a seasonally adjusted basis, we really peaked in January. And when we take a look at May compared to January, we're actually down about 9.7%. So that kind of makes the story a little bit worse, and it illustrates just how much we slid. Even though we rebounded by 68,000 jobs in May, we still have that huge deficit across all industries across the state. So what are our expectations as we look ahead to the rest of 2020? We still have a pretty wide range. We're revising our forecast right now, but we still think this could be between minus 120,000 to minus 160,000 on an annual average basis for 2020. But depending on so many factors, which I'll describe at the end here, I think that there's some optimism that 2021 could be a return to growth year for Colorado's. So now just digging into a couple additional Colorado economic indicators, I wanted to point out inflation, and especially point out inflation compared to the United States. And so when we take a look at Colorado over the last 8 years, I think it's remarkable that we have recorded higher rates of price growth than the nation every single one of those years. And when we take a look at the May 2020 unadjusted number year over year, that trend is more dramatic than it has been over the last 8 years. And it stymies me a little bit why this would persist. But Colorado's inflation rate was about 1.9% year over year in May, compared to 0.1% for the nation. So it was almost flat for the nation, and we were still at about 2%. So we broke this down by subsector. We noticed that removing shelter from that equation, we still were beating the nation. The nation was actually negative if you did not include housing costs. In terms of shelter, we were still outpacing the nation. In terms of medical care, that's one area where we had lower rates of price increases. I want to just mention the Paycheck protection program. There's been a lot of data coming out about this over the last week. We had about 104,000 Colorado companies get loans from this, but most the jobs retained, as they have to report it, were concentrated in accommodation and food services, healthcare, construction, professional, scientific, and technical. And when we zoom into the regions of the state that got the most money, it's our largest cities, our largest metropolitan areas, so places like Denver, Colorado Springs, Boulder, Fort Collins, Aurora. This is where we saw the largest dollar amounts of recipients. But there's a lot of areas across Colorado that were sort of notably left out, or they did not have companies that applied for some of these PPP benefits. So we're seeing a disparity in how that money was spread around the state. A couple closing comments. Rich talked at length about national retail sales and some of the trends that we're seeing by retail sector and between bricks and mortar and e-commerce. Looking at Colorado sales and use taxes, this is a reflection of how the consumer is doing in Colorado, how many retail businesses are doing in Colorado, and then think about how these retail sales also have an impact on upstream wholesale sales as well as manufacturing. Rich also talked about collateral damage. City, county, state government is part of that collateral damage, and sales taxes play into that a lot. So we've seen a 9.1% decrease in sales and use taxes statewide in May. That's an improvement from minus 17% in April. So it's getting better, but it still is creating a deficit that governments are having to fill through budget cuts as well as furloughs and layoffs. Lastly, taking a look at the value of construction, we saw really an anomaly in 2018 construction. We saw a lot of large projects permitted. So then when we fast forwarded to 2019, there was sort of this natural pullback in the value of new permits or value of new projects being permitted. I I think that what's interesting is as we take a look in 2020, year to date through May, we're about flat. So we're down 2.1% for the year, which is nearly flat. But when we zoom into it by sector, we're seeing residential down 4%. We're seeing non-building or infrastructure, roads and such, down 3%, while non-residential continued to be up 2.8%. When we take a look at building permits overall are mixed, where we're seeing an increase in single-family permits and an 18% drop year-to-date in multifamily permits. Lastly, the Baker Hughes rig count is an interesting indicator when talking about the energy industry, which has been severely negatively impacted by the low price environment. So year over year, we've seen the WTI spot price for oil drop 30%. This is an improvement from about a month or 2 months ago. But our Colorado rotary rig count is down 81% year over year. So we're down to just 5 drilling rigs operating in the state, and 4 of the 5 are operating in Weld County. 1 is out in Garfield County. So just closing out, Rich said this, but I'm going to just reiterate it. I think that when we take a look at Colorado compared to the nation, when we take a look at Colorado's 1-month job growth and some of these metrics, I think there's sort of a natural reaction to be a little bit optimistic, but I still am pretty hesitant about the optimism, especially given the extreme volatility and the persistent uncertainty that we have as we look forward to this fall. And some of that uncertainty includes a wave of bankruptcies that we expect to see, a wave of never to reopens that we expect to see, volatility in our virus counts, expectations about the virus coming back this fall, expectations about when a vaccine may become available. So I think that there's so much uncertainty and so much volatility that I'm a little hesitant to say that I'm optimistic about the real near term at this point. So I'm going to stop there, and I think we still have a few minutes to take questions.
Great. We do have a few minutes for questions. As a reminder, please feel free to submit your question through the Q&A interface, and we will ask Rich and Brian. The first question here is from Tyler. He asks, what will the current tension between China and the U.S. mean for American foreign economic policy, particularly in the next 5 years?
Starting off with a softball, are we? That's great. Obviously there's a lot of damage being done to the relationship right now. The coronavirus only exacerbated that, and then forced companies to think more about shortening up their supply chains and moving them closer to home, something I was talking about at the very beginning. But you can also see in sort of world views, particularly European surveys that have been done, that both the image of the US and the image of China have been falling in the global view. So I think what it all portends is less global interdependence and less global trade and slower global growth than would have occurred in a different scenario. Now, I'm not saying none of what we're doing is not appropriate. I'm just saying that the outcome of all of this is going to be, or appears to be at this point at least, more tension, less trade, less global growth.
Okay, thank you for that. Next is a question from Deborah. This came up in our last webinar as well, but if you have any updated thoughts on it, what are your thoughts about those who actually don't want to go back to work yet because they're earning more on unemployment than they did at their jobs, at least while they're getting the extra $600 benefit?
Yeah, so the state is doing a lot with this. People now have to be looking, and if the employer says I offered the job back to them, then their unemployment insurance stops. So but the employer has to be, sort of reporting that to the state. And given the level of what's going on right now, it's might be a little bit more chaotic than normal. That said, I understand the $600 additional payment is substantial. The average for the U.S. is $400 for unemployment insurance at the state level. So you add another $600 to that, and person's making $1,000 a week and probably not making that. Many of these people not making that in their real job. So my thought is that if it probably needs, I'm going to say this very carefully, the federal part probably needs to continue, but I would suggest at a much lower rate than the $600 a week, just because it's going to take quite a bit of time to absorb all of these people back into the economy. So I'm not in favor of continuing it at 600, but I am suggesting that I think it's going to need another round at a lower rate.
Okay, thank you for that. Next, we have a few questions coming in related to real estate. Could you share more about what you're seeing in the real estate industry across the state and what you believe regarding interest rates in the near future?
So I don't know if Brian wants to jump in on any of these. I'll say for interest rates in the near future that we're seeing them as pretty steady, maybe rising a little bit, but not too much. As Brian described, we're in a very benign inflation environment, and we're thinking that's going to be there for a while. You would think with all of this money that's out there that inflation would eventually kick its heels up, but the bigger issue right now for the Federal Reserve is that prices don't go negative. It looks like interest rates will remain low. What are we seeing in real estate? We're still seeing home price appreciation. We're still seeing what seems to be reasonable demand. We're hearing differing types. I think I responded to this on the last one of these. We're seeing industrial warehouse doing great. We're not hearing of any issues about payments or about new construction. We are hearing from a number of different sources that projects are being potentially put on hold, that some of the things are being pushed back a little bit. So there is a little bit of concern, especially I think in the home construction area, that we might start to see a little bit of a slowdown in sort of new construction there. I don't know if Brian wants to jump in here.
Yeah, I think that some of the data that we take a look at is a lagging indicator, so it's a little bit hard to rely too much on that to tell what may happen in the future. Like Rich said, through the first quarter of 2020, we continue to see home price growth, and you know the nation has a more frequent series, and we're still seeing home price growth nationally. When we take a look at single family or multifamily construction, I'm not overly pessimistic about home construction because Colorado continues to have a pretty strong positive rate of net migration, meaning we have more people moving to Colorado than moving away from Colorado. So as long as there's that demand, people have to live somewhere. So as long as there's that continued demand for housing in Colorado, we should see home construction continue, perhaps at a slower rate. I think what's more concerning, though, is the pipeline of commercial projects. When we talk to the construction industry, they tell us that they feel pretty good right now. They have their current project, maybe they have another project behind it. Concerned looking out into the future. So what happens this winter or next year once these large projects go away? But will there be some work to backfill what ends?
Yeah. And when we did our forecast back in December, which seems like a different era right now, but we heard that from the construction committee back in December that 2020 looked good, but 2021 there weren't a lot of projects getting into the pipeline, and then this has only exacerbated that.
Okay, thank you both. With an eye on the time, we're going to move into two final questions and then we will close out. So the second to last question here is from Mike. He asks, what do state government revenue projections look like for Colorado? Will we see massive cuts and higher taxes?
Well, I would direct you to, I don't have the number off the top of my head, but I would direct you to both the Legislative Council website and also the Office of State Planning and Budgeting. They both came out with forecasts in June. They did revise them a little bit more positive than they had been before, but they're still pretty massive cuts. And so right now they're allocating it across programs as opposed to talking about any tax increases that I can see of significance. So I would just highlight, they do the forecast, that forecast, and they do a really good job. So I would encourage you to visit their websites. Again, Colorado Legislative Council or Office of State Planning and Budgeting. There's two different groups.
Great, thank you for that. And then our final question is from John. He says, the degree of economic control during COVID-19 seems unprecedented. Is it justified? Who decides this? Is it hysteria?
Well, you know, this is one of those things that you don't know until after the fact. Obviously it's extreme. The government shuts down, you know, the economy. Never happened before. And I think, you know, I said this in one of the, I think the very first one, part of the problem was we weren't ready for this medically. We didn't, you know, didn't have the facilities in place. We didn't have the testing in place. So I think most people who are knowledgeable about this think this would have overwhelmed the medical system when we went into it. Now, next time around, or, you know, if the same thing happened a year from now, I think we would think about it a little bit differently because we've learned a lot from this experience, but we weren't ready for this and we didn't know how bad it would get. And I would highlight the people who were saying it was so overblown, and right now the estimates and the number of deaths are almost exactly what was highlighted at the very beginning. We're going to have deaths nationwide up close to 200,000, and right now the estimate is, the high end estimate is 197 and the low end is like 180. So we are going to wind up with a pretty severe situation. The question is the trade-off, and that's what you're asking, and I totally get that that's what you're asking, because it's very painful to take on this much debt nationally and to have these many people lose their jobs and lose their businesses. You know, what's the trade-off? And next time around, you know, hopefully we'll approach it with more knowledge and do a better job.
Okay, thank you for that, Rich. And I have a note here from Brian. He would like to make one last announcement before we close. Go ahead,
Sure.
Brian.
I just want to make this group aware that Rich and I have been working with our Outlook Forum committee members to come up with our mid-year economic outlook. This is something we do every year, and we should be able to share it with all of you in the next week or two, so keep an eye out for that. It'll have some revised employment expectations by industry, as well as some narrative from our committee chairs.
Great, thank you. Well, thanks so much to everyone for joining us for today's presentation, and a special thank you again to Rich and Brian for this great information. As a reminder, all webinar attendees will receive an email tomorrow with a link to the recording of this presentation. To view upcoming webinars as well as previous recordings, please visit our website at colorado.edu/business/alumni. We hope that you will join us for our next webinar, which is this coming Monday, July 13th, as Leeds Associate Professor Dr. Stephanie Johnson presents on why we must inclusify now. In the meantime, have a great rest of your day and go Buffs!